Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, December 11th, 2020. This will kind of be a potpourri, mishmash of different things out there I'm watching, just really where the opportunities are. I mean, that's what trading's all about. Identify the best looking setups with the most attractive risk reward profiles, and spread it out. Don't ever put all your eggs in one basket. That means not just putting in one stock, but if you can spread around different sectors, different asset classes such as stocks, bonds, commodities, etc. You're hedging your bets, and you're going to be those times where one trade's going against you, but three others are working out for you to helping offset those any losses there, and that's the whole one of the big benefits of diversifying. So what I'll do, I've focused a lot on the broad markets lately, but I'll cover some of the other things, and just about everything I'm about to cover in this video. It won't be super long, covering a few different things, but they're all just about all of them are things that I've covered recently. I'm just kind of tying it together here for you guys, tell you where I think the opportunities again lie. So first and foremost, first time in a while where we have some decent sell signals, really, about as good as they get on the equity markets. We had those this week, and now we've taken out that 341 support level, and that was where I said the next, objective short entry or buy signal or short sell signal would come. Other than yesterday, when you could have shorted the kickback rally, stopped about where I figured it would. And so that's it. So we're below that 341 level. We haven't yet taken out that yesterday morning's reaction low. Remember, we opened down there and then snapped right back up. But so yeah, that will help if and when that goes, and it'll open the door to that next target. And I also just want to kind of reiterate as well that these are, I've given you some near-term targets, but there is a lot of potential in the charts when you zoom out to the daily and even the weekly charts that say, this could possibly prove to be the start of something much more. So you define your trading style, you define or you identify or choose where you think things are going. And if you want to, swing for the fences, try to hit a, double or triple or home run, meaning a much larger drop, then what you do is you just periodically lower your stops as your trade begins to pan out. You may also want to add to it strategically, such as strategic additions or subtractions to positions are, for example, yesterday when we had the kickback rally. That was an objective time to add some short exposure, as was today's breakdown of the 341. Of course, your first sell signal came the other day when the S&P 500 broke down following this breakdown and back test of QQQ. So those are your what I call strategic entry points. If you're either micromanaging a position, that means an active trader can short that, cover, take the bounce, long, turn around, short again, and and turn a let's say sometimes you'll be a 4, 5, 10% pullback in the market, and if you micromanage a trade actively, you can actually do 10, 20, 25% or more by again, covering, sidestepping, not only sidestepping the give back in profits if you were short, but profiting from a long bounce by going long, turning around, shorting again. So that's active trader stuff, not advisable for those that aren't nimble and experienced. Swing traders, again, might just look to where a move is likely to go and hold on and ride out the counter trend zigs and zags so you don't get stopped out or shaken out of the trade and you can catch the bigger move. So that's it. Nothing big today. We're only down 1.23% right now on QQQ, and it is Friday. So remember, whatever you do today, if you take a new position, long or short, or hold on to what you currently have, you have that 2 extra days or 2 extra nights of overnight risk because we are heading into the weekend. Here's the S&P 500 triggering a I did say we had a support zone, and I'm going to maintain that, and that's right there. There's two support levels in close proximity plus the trend line. But if you take all those away, here, we'll turn off all the lines here. Let me just do this. We've taken out that uptrend line, and that's a pretty important level. There's the uptrend line right there on the 60-minute chart. I think that's how I had it drawn, somewhere right around those lines. And so that's been broken, and so that helps to confirm that breakdown in QQQ, and says most likely more downside to come. Again, it's not impulsive. We are down 8.85% right now in SPY. decent down day, but not that quick waterfall type selling that I'm expecting may kick in here soon. And quickly for the bigger picture, longer term swing traders, zooming out to the daily chart here. Again, we recently had a breakdown with these minor uptrend lines in SPY. This is the S&P 500 tracking ETF. So far, some decent follow-through selling, nothing huge. But what we also have, remember, again, you get little breakdowns along the way, and even they can cause a nice correction. But this one comes after a big divergent high. We have divergences again on the daily charts of both SPY and QQQ, as well as the weekly charts, and that's what leaves the potential that any one of these tops, when you get a divergent high, may and likely will eventually prove to be the big one that marks not just a little pullback or a tradable correction, but a tradable trend reversal. In other words, the next good drop of double digits, 10% or more. So that's it. Sell signal. You want targets, on the daily chart, rough targets, right around. Well, I didn't mean to move the line, but wherever that was, about you can see it there, about 354.50 or so. And then some potential targets there. Don't forget we had this multi-month trading range, in ES or SPY and QQQ. In the bottom of that range, should we fall back within it, would be a likely target as well. So that gives us, let's just say, an intermediate swing target, potential to come down about another 11-12% in the S&P 500. You look at QQQ, same story. You broke the trend line on the daily chart. You did it with the negative divergences, which are now confirmed, by the way. Pretty good resistance or support right there, about 297. We're coming up on it now. So the bulls want to see this, and maybe they get it. Who knows? We'll see. We'll react if and when it happens. Where the bears want to see this, they want to see 297 taken out, and if it's so, then you can see some potential pullback targets, and you also have that same trading range, which we pretty much now fallen back into, because you can see here, not well inside of it. We had this previous all-time high there, that pop there. That was on the first, vaccine good news. I remember that back then. But this is a pretty good level right here. Again, 297. So let's just say that's when we fall back. We exclude that little pop right there. And here's our trading zone right there. So again, that's why I believe if we can fall back well within this 297, below the 297 level, it has the potential and likelihood to take us back to all the way down to the bottom of that zone at 260. We'll call it around 265, give or take. And what should that do for the NASDAQ 100? Take us down about 11, almost 12% there. And finally, there's our confirmed divergence. We have bearish crossovers. All you have to do is put up the, this is a PPO. If you want to see when the lines cross, just put up a PPO histogram. And when the histogram goes from green to red, it means the lines have crossed. So as of today, check, check, check. We have a bearish crossover on the PPO for QQQ. No guarantees. Day is still young. There's another 3 hours left in the trading session, so maybe we can reverse. And remember, this is just like a daily candlestick. The histogram is not finalized to the end of the day, 4 p.m. So it's possible this thing could turn back up. As I like to say, the redder the better. So if we can continue selling off into the close and we get a big red crossover, then it's more likely to stick. And you can see what happened the last time. Last couple times we had a crossover in the daily. There was some downside to come in the markets. It doesn't do it justice here because I flattened out prices, but these were significant pullbacks, or at least tradable pullbacks there. We're a little whippy right here. Here's one right there. There's a really solid sell signal when I take the crosshairs. Look at the line from there. Had you shorted, and from that point the market dropped almost 30%. And just on the flip side, when you get the bullish crossovers after you've been down here for a while with these red, I call them hills. So these are your trend. They are trend indicators. They're showing you the trend flip from bearish to bullish there. It went from bullish to bearish there. Little whipsaw. Stay away when they're kind of floundering around near the zero line. You look for these well-defined hills, and when you get those hills, again, well-defined. There's a big hill right there, and you get those crossovers. So there it is. Boom. There's our latest sell signal right there. Same thing on SPY. SPY has made the bearish cross. It actually crossed yesterday with additional confirmation today. So again, it's not 100% effective. No indicator is. You can see there are whipsaws from time to time, but the more evidence you have to to initiate a short trade or get out of your longs, the better it is. And so far, the evidence continues to mount through today. Again, nothing huge, but we'll take it one step at a time. Okay, just a little bit more on the broad markets, because again, first time we've had some, short opportunities in a while. We've taken out that 12,307 level. You can see there that mentioned recently on the NASDAQ 100 futures. So there was our breakdown. That was the primary trend line right there. There was our sell signal, initial leg down, little momentum overshoot in the morning. That was in pre-market, popped right up to that 12,404 former support. Support once broken becomes a resistance, and that again is why that was an objective shorting op on that bounce recently. And here we are. So we're coming close to, but we're not yet to that previous reaction low. If and when that's taken out, opens the door to 12,080. That's the NQ NASDAQ 100 futures. And for those of you that trade ES, well, those showed you the S&P 500 trend line being taken out. Oh, didn't mean to do that. Let's get that back down. There we go. All the way down. There we go. And show you the trend line the way I have it drawn on ES right there. We don't have a lot of reaction or any reaction since back here. That was in mid to late November. But we do have a few up to that point. So I'm thinking we'll come in here, and there's also some horizontal support. So that's probably our near-term downside if you're looking for where we might get a reaction. And then if we do bounce, maybe a kickback to 36.44. And then something like that. So really what we'd like to see, or what I'd like to see to open the door to, a deeper correction would be a solid break of this trend line here on the 60-minute chart. And again, it's these divergences and many other things that indicate that will likely be the case now that the momentum has shifted and we've broken the shorter term trend lines. Okay, so where are the opportunities? If you want to outperform the stock market, that's what everyone is. Most people's ultimate goal is to, you just want to match the stock market. Just put all your money in S&P 500 index fund and ride it up and down, and you'll do it. And if you want to outperform the market, whether you're an investor or a more active trader, I like to pick the most bullish sectors and be long those, and the most bearish sectors and be short. Just like right before the elections, there's 11 sectors in the S&P, and I said by far the only one that was clearly bullish to me, or the most bullish at the time, was energy, and it needed a break out of this bullish falling wedge, and it did. This is XLE, the energy sector ETF, right after the elections. But we've come full circle now. We're almost my final target was about 42, and that's effectively what we hit yesterday. So point is, we got the run from the breakout. It was about a 42% rally in the energy stocks since that breakout just right after the elections. And now we've come full circle. So just as I had a bullish falling wedge right here, with targets running up to $42, we've hit it. And now we have a bearish rising wedge, negative divergences and an uptrend line. So it's wash, rinse, repeat. Look for these divergent highs, divergent lows, and then you wait for the sell signal. So now I'm not highlighting this as one of the most bearish sectors, although I do think it goes down once we get a sell signal. And the same targets on the way up would at least that initial one, about 38.30 would be my first target on the downside, and then $34 I think will probably good chance. We'll see. Let's see what the market does. But as of now, and I mentioned the other day, one of the most bearish sectors in the S&P 500 to me is the financials. I did a whole video on those, so I'm not going to get into detail now, but I just want to say that we did reverse right at, I told you it was probably a momentum fueled overshoot when I did the video, and we were there the other day just above my 28.64ish, we'll call it 29 resistance level. Pretty good resistance level, goes back in time even beyond the left there. And trend line break and back test right here, and rolling over, negative divergence, and I see some nice downside in the financials. You can short XLF, you can go with one of the bank ETFs, you can go with SKF, I believe it's a 2-time inverse, if that one's still around, and I don't know if the 3 times are still trading. Yeah, I think they are. FAS is the bullish one for the financial sector, and FAZ is the bearish one. So if you like the juice, you go with these. I advise against them unless you, for a swing trader, anyone planning to hold for a while, unless you expect a mostly unidirectional correction. What does that mean? Unidirectional? Well, let's try to look at it here. Those ETFs work great when you have a rally for this, for example, is a mostly unidirectional rally, mostly up, very little corrections or givebacks here. Here's a unidirectional rally. There's definitely a unidirectional drop. You will outperform. You'll do better than 300% in those ETFs in these situations here. But where you don't want to own those ETFs is in these sideways grinding periods right here where you're going back and forth. This is where the decay will just ruin those things. I explained that in the FAQ page. Go to the top of the site, rightsideofthechart.com, go to resources, then FAQs, and go under the ETF related section, ETF related questions, and it's all in there. I explain the math and how that works. It's not just, some crazy complicated formula. It's simple math as to why you want to own those three-time ETFs, long or short, during these strong corrections, and avoid them when the market's grinding around, or a sector if that's what you're going with. But I just wanted to, again, to reiterate, let's keep it simple here. There's the financial sector. Where does it go? I think if the market heads where I think it could head here, need to see a little bit more evidence, but their drop is about 9% from where we're at right now, down to about this $26 level. I have it about 25.90 there. And should this prove to be just a whipsaw signal and these divergences either don't play out or they play out later, in other words, we move a little higher, the divergences get extended, and they play out down the road, then my next resistance is really, there's a little minor resistance here. Let me give you a line just in case we do move higher. Right there, it's a big old gap, a reaction low, and a bunch of reactions there, about 29.88. But again, it kind of goes with what I've been saying. It's the risk reward, the reward if you're long right now. Financials, maybe that 5.5% upside maximum run would be there, about about 10% to that $31 level. But yet the downside, the minimum target there is 8.5%. And I could easily see the financials coming back down to that trading range that I've talked about that the markets were in. It was around this same period here, and the bottom of that range is about 22.50, and that would be a drop of roughly 20%. And of course, you watch the leading banks. There's JP Morgan. Again, this was all covered in a video recently. Breakdown here below the trend line, back test, and we're starting to crack below that key 1942 level. Just starting to really like to see a little more downside. Berkshire, divergent high, rolling over since then, coming right up on support, big level. Bullish if it can hold 223.50, bearish if it breaks it. A lot of thin air, especially a big old gap to backfill there. Bank America rolling over below the trend line, divergent high like everything else. Citigroup lines, steep little wedge type pattern, not super well defined, but enough to trigger a nice sell signal if we get it. Bearish rising wedge breakdown there, first target, second target right there, and again, all these were covered before. Yeah, as far as individual stocks, you can almost throw a dart now. They're more and more setting up. I mean, here's one today. I just happened to be, I was recently shopping around for some new electronics for a boat, and looking at Garmin, it made me think, check Garmin stock. I haven't looked at it in a while. I mean, here's the chart. This is, to me, a pretty clear pattern. You get these divergent highs. So you can see down here your divergences. Divergent high, these are negative divergences. So divergent high number one, and then divergence, as I always say, are not a sell signal, but a break of a trend line or any other type of objective short entry is. There's a breakdown back test, 16% drop off that divergent high. Another bearish rising wedge right here, breakdown back test of the wedge, followed by a 42% drop. Bearish rising wedge, confirmed with negative divergences down below, 13% drop. Negative divergences, little wedge type pattern, could continue for a while or could break down any day. So that's your next sell signal. And there's so many out here like this that, probably just as easy for most to trade the indexes, because if most of these break down, like the bank stocks are starting to crack and some others, then, we'll probably get a broad-based sell-off is where I'm going. Okay, other trade ideas would be, well, let's look at the VIX while we're on the equity markets, and the VIX is starting to move up where it should. Let me get these lines populated. I mentioned this before. We have a pretty good support here. This is a gap support zone right there, and that level 1934 has been resistance in the past. And you can see here we had this, the VIX trades a lot like the equity markets, but in reverse. You had negative divergences, big pop in the VIX. That was pointed out at the time in advance and, at the time of the breakout. And those divergences have only continued to build. Bullish crossover on the PPO recently. Again, just like our bearish crossover in the equity markets, but this came a little ahead of itself. The VIX has actually been leading. It's almost been a predictive indicator for the market lately. Started to move up, and look, rallying already to my first target there, 225.58. And then, we can get a nice correction going here. We have the potential for the next big leg up, and probably bigger than these previous two runs because we have much bigger divergence. So again, a lot of potential built into the charts. Seasonality isn't really with the bears at this point in time. As I said recently, you're going to hear a lot of buzz about Santa Claus rally, where the market rallies into the year end, into Christmas time. Small cap effect where small cap stocks tend to rally in January, but again, I don't go the seasonality might work great if the technicals align with it, but as of now the technicals are saying, look, we can get a decent correction at any time now. It's priced into the charts. We just need to see a few more sectors and key stocks really break down. But there it is. So far, it looks like the early stages of correction to me. And seasonality, hey, works great when it works. Those things are around because keep in mind too, stocks tend to rise much more often than they fall. But it's those times where things go against the trend. When you look at, the Santa Claus, some of the biggest drops in the market have come, into the end of the year, November, December. And so, again, I caution you to be solely long or solely short something just because of the seasonality. You want to go off the charts. Let the charts be your guide first and foremost. All right, finally, what else do I have for you? That's it. And then other things I mentioned today. I mentioned copper as one that is setting up. This is the copper ETF, CPER. Somebody asked under that post, hey, better to do a short, or go, trade a company like Freeport McMoran, which is, they mine copper as well as other metals. It's not a pure copper play, but they're one of the biggest, bigger copper producers out there. And so there's a chart, a trend line on the daily chart. And I posted, under that post, I posted this 60-minute chart, kind of cracking the 60-minute uptrend line, negative divergences there. I'm not crazy about these targets, but I laid it out. But again, now, here's the thing. Okay, and the question was, is copper thinly traded? So yeah, you don't have the liquidity there, but remember, if you're trading a thinly traded stock, especially a penny stock, something low price, you can really get trapped. And what can happen, fundamentals can disconnect tremendously if people aren't buying the stock or if they're selling it, and and the company's growing, earnings are strong. It doesn't matter because that company can be disconnected. The stock price can be disconnected from the underlying valuation of the company by a huge amount, and that can happen for a long period of time. That's where investors like Warren Buffett, long-term, make their money. They sniff out undervalued companies and they buy them and hold and wait for the market to recognize that. Okay, where am I going? On an ETF or an ETN, which tracks the underlying, you're going to have sorry, I had to pause the video. Interruption there. Yes. Anyways, these ETFs and ETNs will track a commodity, and so they will then therefore follow the price, if you will. Now, what you need to be aware of on thinly traded securities, even if it's an ETN or an ETF that's tracking a commodity or something else, are the spreads. And what you do there is they have large spreads. Don't use market orders. Use limit orders. Split the difference. If you use a broker like I Interactive Brokers, they have a thing I like to use called an IB algo order, and it puts it's an algorithm program. It puts the order in, and it will sniff out between the bid and the ask price, and they'll look at everything that's going on in the market, and the algo will try to fill you with the best price possible. So it does that. It kind of does that for you. In the old days, I would usually split the difference between the bid and the ask. If I wanted to buy it, something going up, I might go a little closer to the ask price, and sometimes I wouldn't get filled. You have to move your order up. It's not always so easy because if a stock is running up or down, sometimes you have to keep canceling and replace your order. But that's where the IB algo order helps. It'll move with the market. Okay, so enough on that. And then remember, this ETN, I believe it's an ETN, will track the copper futures. Got to be careful. Some of these, it might say like wood or cut, or lumber, but they track forestry companies, not lumber futures. But on copper, it does track the futures, I'm almost certain. And then you want to use the futures, even if you don't trade them. Even if you say, well, I don't have a futures account, or I don't have the capital to put into futures contract because they're highly leveraged. Um, every contract to HG is somewhere around, what is it, represents about $88,000 of copper. So in other words, so if it moves, you get a 10% move, you just made $8,800, or you just lost $8,800 per contract, even though you don't have to put up nearly that much capital to buy it, because they're highly leveraged. That's how futures contracts work. So if it's not your thing, you could still watch these. You get, if you're, most brokers interact. No, was it TD Ameritrade? A lot of retail traders have that. They'll give you free quotes on HG. Looking at it now on one monitor. I have a monitor with a mosaic of charts from Thinkorswim. I don't even really trade with them. It's just they have good charts, so I'll leave it up on a monitor. And I have HG up on there on one of them. So that's one where you can get it. Investing.com, free charts on stocks and futures, real time too. So it makes sense if you don't have a futures on your charting platform. Open a free account at investing.com and then start a watch list of these, and keep an eye on it. Even if you're trading CPER as your proxy, here's HG, and I'll give you another level right here. I see some support right around there. So that's really what needs to crack right here. This is a hourly chart right here. There's your uptrend line. It's not super well defined. I can play around with it a little bit like this, but you see the gist of it. Once we break that, and you have a little support zone here, that should open the door for a decent correction in copper futures. And then you zoom out to a daily chart on HG, and you can see just a pretty well defined uptrend line. This is our divergence line right here, showing that negative divergence continues to build. It's been a heck of a run off the March lows, about 88, almost 90% rally if I recall correct, maybe 80% rally, something there. But this is also a play on economic growth. There's been a just tremendous amount of optimism. I'm in one of those camps. I almost wish I didn't go. I was a business graduate. That was my major, and I almost wish I didn't know what I knew. We're still in a recession, and it's crazy. Yeah, we had a strong bounce back in GDP, but we're still well below where we were before. And this is the only time, I think, in history that the stock market's made all-time highs and still trading at all-time highs while we're in not just a recession, the start to one of the worst recessions in history. Yeah, again, strong rebound the last quarter, but it still puts us a lot lower where we start. Here, let me just expand on that real quick, what I'm talking about. All right, this is GDP. This is what measures. Recessions are based on the GDP, gross domestic product. You can read up on it, how it's calculated, et cetera, et cetera. So here's our GDP numbers, and it's reported every quarter. So what we're going to do is simple math here. So this represents growth in percentage terms, and or a decline. So there we had and we're going to use a baseline here. It's simple math. I'm going to take the number 100. Everyone, easy math to work. So you have a 5% drop. So you just multiply 100 times 0.95 to give you what a 5% drop off 100 would be. So 95. So that brings the baseline down to 95, followed by a 34.1% drop the next quarter. So now we go times 0.686. That would be 68.6%, and that gives us 65.17. So there's our blowout quarter. These were the worst drops we had since the Great Depression, and the biggest up quarter. So 33.1, yay. Well, let's increase that now. So you multiply that time 1 times 33.1. That is an increase of 33.1%, and it gives you 86. That's where we're at. So in other words, we're still, the economy, GDP, if you want to go by that measure, is still almost 14% below where it was heading in to the beginning of the year before COVID did everything. So again, this is just And it's simple math too. You think about a stock. If you have a stock, it's $100, and you lose 75% of your money. It drops to $25. That stock then doubles. It goes to 50. You're like, wow, 100% return. The stock went from 25 to 50. But guess what? You're still 50% below where you started. So that's what's going on in the economy. The economy is nowhere. It's not back to where it was started. It's not even close. But yet the stock market's at all-time highs. So there's a big disconnect between what's going on there now. Well, I'll tell you what it is. It's expectations, and maybe everybody's right. Maybe these vaccines are panacea, and everything's going to get back to where it was, and then some. Because again, the market has to now get back above the economy where it was to justify these valuations. And let me say this: I hope to God it does. I want to see the economy strong. I want to see friends, family, everybody. I want to see everyone doing well. Who wants a recession? However, let's just hope that that's the case, because it appears to me that the downside risks at all have not been priced in. In other words, this market's priced for perfection. It's priced for COVID just going away, these vaccines just eliminating the effects, COVID's having on the economy. Everybody comes out. Planes are full again to their previous routes, cruise ships, vacations, restaurants. I mean, just today, Kumo shut down. He ordered all indoor seating in restaurants in New York City to be halted. So, because our hospitals are full. So, there it is. Hey, maybe everyone gets this vaccine over the next few months, and the restaurants in New York City are full. But you got to, the impact that that's going to have to the economy, and everyone's stimulus will take care of that. You cannot continue to stimulate the economy and support failed businesses. If restaurants continue to be empty, planes continue to fly, half full or less, or cutting back on their routes, eventually it's going to have a big impact on the economy. So enough of those rants. Let me just continue on to a couple other things. Again, the whole point of this video is where to make money right now. A couple members of the site had mentioned natural gas recently. I haven't updated in a while, but they pointed out, and I agree, and I said that on the posters, recently put in a divergent low. I hadn't updated it for a while because we didn't have a lot of levels or developments worth noting. But there's 60-minute. This is the 60-minute chart. Divergent low. It is not a screaming buy in my opinion, because I don't see, the daily charts aren't as clear to me. But one that's currently in an uptrend right now. I hate to force that downtrend line, but it may come into play. Is it objective to buy here? Maybe, because there's momentum going on, but you just want to not hold on to it too long. Natural gas will kill you. I just wanted to do that update and also say that other than that, maybe some resistance right about here where we're at, because you have that previous reaction high. I don't have a very solid read. I love trading natural gas, and that, by the way, that is a good target right there, about 295 or so, 298. That's some really nice resistance and a potential target. But natural gas, I sit back and I try to be very patient and wait for the beautiful setups. I think this was the last time. I'm trying to remember. No, maybe it was right here on this divergent low. But there's a nice big divergent low on the 60-minute chart. Well-defined downtrend line. That's my kind of setup. And I believe that was the last one that I did point out. And we broke out right here, back tested. So if you missed the breakout, another objective entry. And there was a nice tradable trend. That tradable trend ended with negative divergence right there. Sorry for all the lines in there for correction. So there it is. But part of me suspects that we could get one more leg down and put in a bigger divergent low. So I'll keep an eye on it. And again, if you're long, the near-term trend is up. Just don't fall in love with it. Set your stops strategically. Where would that be? Well, it depends, of course, where you entered and where you think it's going. But I can tell you there's some pretty decent support. Not great, but decent around 2496, 469, 2469. And finally, agricultural commodities. Coffee's still hanging in there. We put in this divergent low, pointed out recently, objective long entry, highlight at the time, was moving up, took out this trend line because we put in a divergent high. And so far it's corrected, but see what it's doing here. It's correcting more so in time, by moving sideways after that divergent than price. And that is indicative of a bull trend correction versus a lasting top. Here we had a top that was a significant top, and that was followed by, a pretty big correction right there. So I'm still bullish and long coffee, and then wheat's starting to look good. I think, in fact, I mentioned wheat a couple weeks back, but when we go to JO, that's the coffee ETN, and it looks again like this was the last time it was pointed out here. Positive divergence there on the daily chart, just like we had a divergent low here, divergent low here, divergent low, wash, rinse, repeat. And so, I still think we may be in the next uptrend right here with a little corrective period. Sometimes you go straight up, sometimes you have corrections, and quite often you have corrections along the way. Like here you had a breakout, nice, pretty decent correction, and then another leg up. Here you had a breakout, you had a correction for a few weeks, and then the next leg up. So I'm leaning towards that scenario right there, and maybe ultimately a breakout there. So coffee, not a hard buy right now, but again, somewhere to put money, and as long as it holds up. Wheat, I believe that I mentioned this. We've had many trades on wheat, swing trades. Wash, rinse, repeat. We keep buying it here around 490. Swing it long, swing it long, swing it long, up to the top of this trading range. This is big resistance around 610 right there, and then we had a pullback when we hit it again. That was pretty good resistance. And we pulled back to this former T2. That was resistance around 550. Resistance, once broken, becomes support, and boom, look at that explosive move off there. So they're stepping in, they're buying wheat, and it isn't an uptrend. And again, I'm longer term bullish on wheat and a lot of these other commodities. And there's a little minor downtrend line start to take out. So I think if wheat, and I think it will ultimately do it, can finally break above this 610-ish range, boom. That's I think this will be, in hindsight, we'll look back and say this was the end of a bear market in wheat and a lot of these ag commodities, and this breakout was the beginning of a new bull market. So that's what I'm looking for there. And again, as long as this level holds, that's an objective stop now if you're long wheat, if you bought it on the pullback, and let it run. Okay, long video, a little longer than I thought it because I've rambled a little bit about the the macro, the fundamentals, economic fundamentals. But that's it. There's the trade ideas, and that's not a complete list, but some of the things I'm watching. And again, very little, if any, correlation between wheat and the stock market. So, the nice thing about that is I might be wrong on one, right on the other, and they kind of balance themselves out. And again, the more that you have, the more it's going to help to smooth out the bumps in your portfolio, whether you're an active swing trader or a longer-term investor. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.